Welcome to Massive Passive Cash Flow, the podcast that guides professionals to financial prosperity. Join our community and let's start building your wealth. Here's your host, Gary Wilson.
Hello, welcome back to the Massive Passive Cash Flow podcast. This is Gary Wilson. I'm your host today. It's good to have you back. Hey, if you haven't done so, would you mind please go ahead and subscribing to the podcast on any of your favorite channels, Stitcher, iTunes, iHeartRadio. It really helps with getting things promoted and sharing information when people do their subscriptions. It helps a lot. So we got a great guest today, Chad Griffiths, so introduce in just a moment. But I want to remind you, we just created a brand new website called the Global Investor Agent website. And it's dedicated just to the agents who are trained to work with us investors. They're not traditional agents. They're specially trained to identify, analyze, and negotiate not just on-market, but off-market deals too, which is really important for us investors. And they have the tools to do it. Just the United States alone, they have access to every single parcel anywhere in the country. It doesn't matter if it's commercial, residential. They can get loan information, delinquent tax information, all kinds of information. And for those of you in Canada, which is about 5% of us, we do have tools there too. It's different because the two countries are different. And Canadian systems are better than the American systems, but the data is more highly protected. So we use different strategies in Canada, but we have agents in Canada too. So never fear. Any case, go and grab yourself one of those guys or gals because they know what they're doing. All right, it's a great resource. Let's go ahead and get to the interview today, Chad. Welcome aboard, man. I'm so glad you were able to do this, and we certainly appreciate it.
Yeah, thanks so much for having me on, Gary. Really excited to chat with you about this.
Excellent. Hey, if you wouldn't mind, I know you're speaking of Canada, you're in Western Canada, but would you mind giving people a little bit of background, how you got to where you are, and that'll provide some context for us to launch from, if you don't mind,
Yeah, great introduction to get started on that. So I'm based in Western Canada. I don't know if anybody watches Yellowstone, the series on Netflix, or no, it's on Netflix. I believe it's on Prime. I'm kind of straight up from the Dutton family ranch is where I'm located in Canada. Wow. And I got started in industrial real estate in 2005 as a broker. So I've been actually at the same company for 17 years now or so. And I've started investing in industrial real estate myself in 2014. And with different partners, we've pretty much been acquiring a property a year since. And we're in a market that has a heavy oil and gas exposure. So big manufacturing area. And as you can appreciate, with oil dipping quite a bit over the last few years, we've really been buying in a dip. So we're hopeful now that oil prices are going back up. Industrial real estate market as a whole has been pretty robust all over the world. So hopeful to keep buying a property a year for the foreseeable future.
Yeah, I agree that it's interesting the way the economy is now. It does look like, there's so many factors. And one of them is that, China, of course, is growing more and more as a major economy. And that if the trend continues, it'll be a certain period of time when they've surpassed the United States. As far as size goes, in the size of their economy. Now, what that means is that it's not necessarily a bad thing, but what it does mean is there could be a change in the world's reserve. So right now, the U.S. dollar is the world's reserve. Every transaction that occurs internationally, they use the U.S. dollar as their basis of exchange. That could change, and it's not. Some people can see it be as a bad thing, but to me, it's just the evolution of the human experience and the economies. But everything is so much more mobile now, and everybody's so much more transient. Even with the virus, people are still commuting from country to country, have multiple passports. And so when it comes to this type of investing, you've got all kinds of opportunities all over the world. And I know people that invest in Ukraine right now. They're still very high on Ukraine, even though they feel like it's politically at risk. There's a lot of natural resources there. When you look at Russia alone, talk about natural resources, and Canada, obviously, abundance of natural resources. So what can we tell people, Chad, if you don't mind, anybody who's interested in investing industrial? I'm sure you've done a lot of business in Canada too, but what other countries, and we can include the U.S. too, if you want to, would be good places to look for this type of investing? Where in the world kind of makes the most sense right now,
Yeah, I think the first step would be to actually just appreciate how large the industry really is. And for the most part, it's tucked away in industrial parks or commercial parks. So it's not top of mind for the average investor to even be thinking about industrial real estate. But I'll use US as an example just to show how big the market is. And it goes back to a study. The most comprehensive one that I know of was in 2018, where they just looked at how much inventory was in the US. And there's 20 billion square feet worth of industrial real estate inventory in the US with an aggregate value over $1.5 trillion. Like, it is a massive, massive industry, but it's just not appreciated by the average person because they wouldn't have any direct reason to look at industrial real estate. So I'd first look at the standpoint that it's a really big market. So there's opportunity everywhere. If you're in one of the big port cities right now, you're probably hearing how vacancy rates for industrial are sub 1%. There's a scarcity of any type of industrial real estate at all, which has driven up prices as just supply and demand will go. But even in some inland markets, everything in Texas is really, really hot right now. Big industrial hubs all over North America are booming and are at all-time lows for vacancy rates, and some markets are experiencing all-time highs. So I would start by saying that the first thing that people could do is just get a sense of how big the market is. And then once you have an appreciation for that, then you can start digging into individual metrics about different types of properties and opportunities that can come up.
Okay, so let's talk about that for a second then. So are there resources people that can have available to them? Like I know there's all kinds of websites that you can look at now. There's different commercial brokers that are very good at providing data. Some of them specialize in multifamily housing, some specialize in resort areas, some specialize in office. But when it comes to industrial, are there a couple of resources that you can think of that would be helpful for people just to start learning about that business, that sector of the economy, you know?
Yeah, great question. And I would say as an overarching comment first is that it really does require someone to be a self-starter if you want to get into industrial real estate, because it's not as prevalent as other industries are. And as a result, it's harder to find some of this information. But if you're prudent and you're resourceful, some of the things that I would certainly recommend doing is start by focusing on one market, just because it can be a very overwhelming proposition to learn a new asset class and then try and look at it from a global or even North American context. So I'd start with just one market to begin with, and perhaps you will open it up afterwards, but focusing on one market will allow you to really get an understanding of macroeconomics. So what is industrial real estate in a broader sense, what's happening trends wise globally, and then you can drill down and get more microeconomic factors like vacancy rates and absorption and what's happening with lease rates. And like you said, a lot of the brokerage companies will provide quarterly reports. So some of the bigger ones would be JLL, CBRE, Colliers, Cushman Wakefield, NAI, Avison Young. These companies will typically produce quarterly reports where they'll actually detail some of the big transactions that are happening, what's going on with lease rates, is there a trend over the last quarter or year over year, and then we'll also talk about absorption or big construction projects underway. And once you can get to the habit of just reading these reports, the more you read, the more you're going to start getting a better overview of the market itself. And then I would couple that with physically going out and driving some of these industrial areas. So most US cities that I'm aware of will have their industrial markets segregated into distinct areas. And there's good reason for that. They don't want to have industrial right next to residential because there's noise and odor and unpleasant sights that can often accompany industrial areas. So they'll typically be segregated into a few different areas in the city. So I'd recommend people just go out and actually physically start driving these industrial areas and start getting a sense of all the different types of companies that are occupying these buildings. Start looking for how they're configured. Is there grade loading? Is there dock loading? What are the ceiling heights? How much land areas it comes with it? Are these aesthetically pleasing buildings, or are they just literally four walls and a roof designed to serve a specific purpose? And if you can start driving these areas regularly and start noting some of these trends and things that are happening in the market, and you combine it with that knowledge of reading industry reports, whether it's from brokerages. There's some great newspapers and magazines out there. Globestreet.com, which is globest.com, is another great resource, and then you can sign up for a free account and get updated anytime they put out news articles. You just really, first, it's incumbent on everybody to realize that it is a steep learning curve if you have no knowledge of it beforehand, but you can get up to speed on it relatively quickly if you're willing to put it in the work.
Yeah. Well, I tell you what, I appreciate that, by the way. It's definitely big help. One of the states you mentioned was Texas, and Texas is definitely interesting. It's a giant land area. It's a giant state,
Mm-hmm.
lots of land, but it also has one of the largest metropolitan areas in the U.S., which is Houston. It's, you have New York, L.A., Chicago, and Houston. And Houston clearly is a big industrial area. But what about some of the smaller areas? We'll just stick with Texas. I've been to Amarillo, been to Lubbock, Midland, teaching real estate classes, and they're mixed agricultural and industrial. It's the craziest thing.
Mm-hmm.
But is there any logic behind, hey, if you're going to invest in industrial, you should stick with the major port areas like Houston or, LA or Baltimore, or Seattle, or is it okay to go into some of those secondary and tertiary towns? Like I keep thinking of Lubbock because I actually just did an interview with somebody there, and it's good. And I've been there for a couple of years, but it's clearly industrial. So does that size matter and where it is relative to port cities and things like that?
Yeah, I think port cities, if someone had a crystal ball and they went back 10 years and they could see into the future to where we are right now, those port cities have done exceedingly well over the past decade. And it's just a factor of very, very low vacancy rates drives up the prices. I don't think that those port cities would necessarily be the best place to invest right now because you're buying at the absolute top of the market. Yeah. Whereas some of these more inland markets, and another one in Texas, which has actually done very well, is that the Dallas-Fort Worth area. They've got about 45 million square feet of industrial space under construction right now, which is an insane number. There's cities in the US that don't have 45 million square feet of inventory total, and Dallas has that much under construction. So that market's doing really well. San Antonio, I think, is going to be a really up and coming market, particularly as the highway can go right from Mexico right into middle of US, and San Antonio is right there. So I think that could be a bit of a gateway city between stuff manufactured in Mexico and brought into the US. But I think instead of focusing on broader markets, I think the best place to start naturally is just the market that because you're just going to have insider information that someone outside of the city just won't have by virtue of not driving on the roads every single day and having the ability to drive into an industrial park and see what tenant just moved in or what property just sold. There's an advantage to investing in your own city. That's not to say that that's the only thing that you can do. I just think that that's a logical first place to start. And then if you were to look outside your city, I would look for areas that just have growth. So in-migration, whether like Texas is a good example, Florida is a good example. There's a lot of in-migration to those states versus some of the more northern or Rust Belt states, which might be having outbound migration. That's not to say that those markets can't be lucrative either. I think that if you're trying to get in the path of growth, you want to have population growth first. So that's kind of the order of how I would look at it is look in your own backyard first and see if you can make a business case for why that market makes sense. And if it doesn't, then start looking at markets that are going to have positive migration growth going forward. Yeah.
Well, something I just realized that's really interesting here is the town that I'm in now is actually named Industry. It's Industry.
Is it right?
And right across the river, we're here because we were on the river. We get a great view. And we can't see the plant, but up just maybe a mile is a shell plant from all the fracking they're doing. They're going down and separating the bedrock to extract more gas. They take the byproduct. They're making these little plastic pellets that are going to be used for creating plastic cartons and things like that. It's a major plant right across the river. And it had an immediate uplift in the whole area. All the rents doubled and prices doubled for the houses, and they're looking at building another one. So it's kind of interesting. And we're 45 minutes from the nearest city, which is Pittsburgh. which obviously is historically a very big industrial town.
Absolutely.
But it just goes to show you, when you said, look, we're right where you are, I literally can look across the river and see a perfect example of that.
Well, and you can sorry to interrupt you there, but you can appreciate how all that fosters even more development, right? That big plant that goes in there. Now there's going to need to be service companies that help service all the machinery. There's going to be warehouse space that's going to be required for all their demands, and then a whole new economy develops around a big plant like that going in there. And that's why I think that you'd want to be in the path of growth, wherever that is. If you're in an area where there's going to be some catalyst for new economic development and new industrial development, then that just feeds everything else, and you start seeing other opportunities open up.
Yeah. And for everybody listening, if you're driving, don't write this down, just replay it later. But if you can write this down, there's a great website called howmoneywalks.com, How Money Walks. It is tracking the migration of money. It's in the US only, but it tracks the migration of money by using IRS tax filings. So it's not necessarily the migration of people, but the migration of money, which means generally the people will follow. So in some of the great growth states right now, and historically have been this way, is of course Texas, Florida, Georgia, the Carolinas, but oddly enough, Tennessee is in the mix now.
Yep.
It's per capita one of the fastest growing states. You got Memphis and Nashville, and even over east to Chattanooga, and going up to 75 to Knoxville, and little towns we used to hear about in country songs like Pigeon Forge and Gatlinburg. They're now players. People are moving there, spending a lot of money. So this is really good, because I know I forgot to mention earlier, we also have listeners, and I think in 50 different countries right now. So for someone, do you have any experience working with people? Here's a good example. I know when I was living in Canada, and I still have friends and family up there, when they invest in the States, there's some factors you need to be aware of, as far as like the countries are very reciprocal when it comes to availability of data. And they are reciprocal when it comes to taxes also. So is there anything for Canadians to be aware of who want to invest in U.S. industrial space that may be different than Americans investing in Canadian industrial space? I mean, it should be similar, but I'm not familiar with going the other way. So I don't know if you have any knowledge on that, or what happens when someone does invest across country lines. What are some of the things to look for?
Yeah, I'd hate to even comment on that from the standpoint. I'm not an accountant or a tax lawyer, and I'd hate to say something out of turn and then be liable for that. What I would say though is that there's a lot of investors that not only invest cross border, but they invest in other continents. I've talked to people in Israel, Saudi Arabia, Vietnam, London, Australia. I've talked to people all over that are all either interested in investing in North America, or they're interested in having people invest there. What I would say is, before you make any out of country investment, is to have a team involved with you. So that's, like you said, you need to have a broker that's representing you in that specific market, that knows that really well, and then round that team out with either a tax lawyer or an accountant that can help you with those. Not like a family lawyer or someone that you perhaps use for other purposes, but someone that's dedicated to tax law in that specific area that can help you use that as a roadmap. Because I think the best investments are the ones where you've rounded out a team of professionals that cover any of your blind spots, and then you've also done the additional due diligence of just getting to know that market really well. And I think if you've got that team and you've got the knowledge and the expertise and the focus on learning everything you can about that market, your chances of success go up exponentially.
Yeah, I agree 100%. We do have an attorney. I guess I can mention her name. Her name is Lauren Cohen, and she's in Toronto and New York City, and she is an international attorney. She specializes in international trade. So I don't do a lot of it myself, and of course I've been in both U.S. and Canada living in both places. So on my own, I think when I was there, I had to pay an extra 10%, hit by 10% tax on top of what I was already paying. But I'm thinking, well, at the end of the day, and that was on net, by the way, but it was an easy thing to do because the gains were so much greater.
Yep.
Are there places in Canada you can think of that are look like they're going to be the next growth area or already are growth areas for people to keep their eyes on?
Hi, Gary here. Just want to say thanks real quick for listening to the podcast. We really appreciate you doing that. And all I want to do is take a quick minute to introduce you to the Healing House Foundation. Okay, so if you're watching this on video, I'm going to let you see it. If you're on podcast, you're not going to be able to see it, but you can see it in the click on the show notes on globalinvestoragent.com, and you can see, well, that's the main website, globalinvestoragent.com. This is a great place for you to connect, not just with me, but with all the agents we have around the country, and check it out. But more importantly, if you click on the Healing House Foundation, okay, you can read all about it. And this is a 501(c), totally voluntary. Nobody here makes a dime. So all the proceeds, 100%, go to local needs in your area where you live for people that need help, all walks of life. I mean, every one of us knows somebody that needs help. And this is our way to come back full circle in the world of real estate where we make so much money. Let's help those who are in need. Sometimes they need a helping hand. Sometimes they need to be taught how to fish, and sometimes they just need to fish. Sometimes they need both. So this is a way for you to participate. Check it out. All kinds of stories, examples. It's very flexible in that we can earmark funds for a particular need that you have in your area, as long as it's related to the need of housing. That's all. It doesn't matter what the underlying circumstances are. We pray for healing for everybody. So in any case, thanks for indulging me. Let's get back to the podcast.
Yeah, it's interesting. Well, and a market you know well, Gary, is Toronto. Toronto is a big industrial market in North America. It'd be in the top 5 or very close to the top 5 biggest industrial markets on the continent. But interestingly, their vacancy rate now is below 2% as well, just because of all the population growth and the whole economy expanding around the area. A market where there's less than 2% vacancy would be troubling for me, just from the standpoint that you're already got any upside priced in. Like it's hard to imagine vacancy rates going to 0. So you're really just relying on some sort of capital appreciation in there, as opposed to just the market improving in general. So I'm in Alberta, which is similar to Texas. We've got a heavy exposure to the oil and gas industry, and with oil and gas being depressed for the last 7 years, our prices saw a dip with it as well. I think given the fact that oil seems to be stabilizing in that $90 range, all this geopolitical risk threatens to put it over $100 a barrel if a war does break out in Russia and Ukraine. And if that were the case and we saw over $100 oil for some foreseeable future, and couple it with just the economy seeming to be going pretty smooth right now, and this continued demand for high quality warehouse and distribution space, I think Alberta hasn't priced in a lot of that potential upside yet, and we're still flirting with values that are a couple years old from all the external factors from there. So I would, that's just a market that I happen to know a lot better because I'm in it, but I would look for similar types of opportunities. Look for states in the US that have a heavy oil and gas exposure that probably have been affected greatly over this oil downturn, and see if their pricing is still reflective of a few years ago, or if it started to price in a big increase coming in drilling activity all over North America. I expect that we're going to see a lot of drilling in 2022 and beyond here. So I'd be looking at markets where that hasn't been priced in yet, where there's still some downward pressure on pricing because of the oil and gas downturn, and see if there's an opportunity there. Like in my mind, that's going to be population growth, right? Like where a lot of people have gone to the Sun Belt for better weather. The other way that people migrate is if there's job opportunities. And if some of these oil-heavy or oil-rich states have a lot of oil reserves, there's going to be a lot of drilling going on, and these companies are going to need to hire people. I think that there'll be population growth in those markets, and that just goes back to my earlier point. That'd be the first thing that I'd be looking at. It's not the only thing by any means, but that's the first thing I'd be looking at is population growth.
Yeah, I agree. That's the big driver, you know. There's a famous story, actually it was Pittsburgh, by the way, where back Pittsburgh had gone through a major change economically back in the 70s with the steel industry, to change in the steel industry. The car and the auto industry, and it transformed. And then in the 90s, it went through more of a renaissance. economically became more of a financial center, high tech, higher education, great medicine, and less industrial. But there's still a lot of industrial around. That the challenge was the leadership at the time tried to give tax incentives for businesses to come into the city, and they thought they would bring the people in. All the real estate people said, it doesn't work that way, Mayor. You got to bring the people in first, and the people will create the demand for everything else. So now we have a new leadership, of course, in Pittsburgh, and it's definitely they've taken advantage of the waterfronts and where they used to be industrial. Now they're office and residential and entertainment. Big football stadiums and baseball stadiums and things like that. They still have the industrial sites, but they're further upriver. And so it's interesting to see things transform. And Pittsburgh is a great example of that transformation. But what I want to, and so the industry changing here. So really what I'm leading to is another question is, when it comes to investing in the industrial sector of real estate, commercial real estate, I've seen plants like a Volkswagen plant, for example, got transformed into a Sony plant for the big flat screens. So when it comes to the particular type of industrial, is there one sector or segment that historically better than others, like giant storage space or manufacturing space versus chemical, anything along those lines you can help shed some light on? And it may be different by different area. I'm not sure. I've never looked into that. And so if you got any insight on that, that would be great.
Yeah, I'm really glad you brought that up, because there is a difference between subcategories in industrial real estate. And I usually point to three different subcategories. The first being warehousing or distribution space. So these are what everybody's familiar with now, like an Amazon fulfillment center. It's just a big warehouse with racks of storing. Things come in, they get stored, repackaged, they get shipped out. That's a warehousing side. The other major category is manufacturing. And that could be like a plant, like you said, whether it was like a car plant or whether they're producing Sony TVs. That's a manufacturing facility where raw things come into the building, they're manufactured or assembled, finished product or semi-finished product gets shipped out the door. There's a pretty big distinction between those two types of properties, even though they're both technically industrial real estate. The warehousing is geared for distribution types of companies, and those buildings aren't necessarily conducive or compatible for a manufacturing tenant, and vice versa. You could appreciate that Sony plant now that's making TVs, that wouldn't make a good distribution center for Amazon. So it is important to differentiate between manufacturing and warehouse properties. And I'll answer which one I think would be best in a second. But the third one would be flex properties. And flex industrial properties are generally all the other properties zoned industrial that aren't necessarily compatible for warehousing or manufacturing. And I'm sure it's the same in around your area or Pennsylvania as a whole. There'll be some industrial buildings that are car dealerships, art galleries, churches, straight office space, bottle depots. There's a virtually endless amount of uses that can go into these different types of industrial properties, depending on the zoning of the local municipality, of course. But they're all the properties that aren't necessarily geared specifically for manufacturing or warehousing. Those ones case by case basis, just because they are somewhat unique and they're going to offer different things to different tenants. I think manufacturing has struggled over the last 6 or 7 years, just because there's been a continued shift from manufacturing from North America to overseas. That trend has continued to happen over decades now. And then we also had the added burden of low oil prices. So the oil industry is a massive, massive industry. And even if the state that you're in doesn't have heavy oil and gas exposure, there's still a lot of service companies and providers and warehousing and distribution networks that are required just to get oil and gas products to the end consumer. So it's a massive industry. And when we saw oil prices get depressed as much as they did, that had an effect on the manufacturing side as well. So over the past decade or so, warehouse properties have unquestionably been the best opportunity. But that also goes back to my earlier point, is that if you had a crystal ball 10 years ago, that would have been what you'd invested in. Now those prices have all accelerated so high that you're running the risk of buying at the top of the market again. Whereas I think a lot of these manufacturing properties haven't caught up to the fact that we're going to see $90 oil here. That's going to mean local manufacturing making some sort of resurgence. all the companies that have to service the different oil and gas direct providers. I think that there's going to be some upward demand on that manufacturing component, and that hasn't been priced in yet. So I myself as an investor would be cautious going into a warehousing property. I'm still not saying that it's not a good investment, because some of these companies leasing it are paying a lot of money, and if it's on a 10-year lease, you're really getting a pretty good property with a good tenant for a long term. I just look at it of where's the best opportunity, and if I try and extrapolate out a few years, I think oil is going to be up for the foreseeable future until the supply can catch up. And it's a big moving machine. It doesn't turn around that quick. So I think we're going to have higher oil prices for a few years still, and that's going to all trickle down to manufacturing space. So for myself personally, that's where I'd be looking, is where's there going to be some population growth, where are properties potentially mispriced according to where that growth might come. And that's not a bad play in my mind.
Yeah, I agree that when you were talking about the space, the storage space, you're absolutely right. I mean, it's been a growing need and lots of demand for it, which means there's more demand for land. That's one of the things we're seeing across the spectrum of real estate, both commercial and residential, is all of a sudden what we used to consider like almost an endless supply, like, what people would say, don't really invest in land because that's not where the money's in the building on the land. The land's just dirt. Well, now we're seeing prices for land skyrocket. And one of the things that I've seen, and I don't know if this is part of your field, is data centers, and not the big giant massive data centers that are several football fields, but smaller regional size ones. And they want to be near population centers where they have a major roadway and an infrastructure, like for utilities. They need electric, so they need a big electric hub. And it's hard to find land that's available for them now. And they're building these data centers. They're using dome technology, and the first one was done in the University of Oregon. And now everybody is really big on these because of the building technology. They really don't even need HVAC, which is unheard of in the world of computer science. I grew up in computer science, and we needed lots of HVAC for these giant computers. Where now these servers are much smaller and far more capable. So in any case, have you heard anything more about that? I'm really going to be looking into this myself, but these data centers apparently are just starting out, and they're looking for a lot of money.
Yeah, you hit the nail on the head there. It is big business, and it's expected, really, when you see how much bandwidth and memory and cloud storage that we're all continuing to require at an increasing pace. It's only a matter of time before these companies have to build out more and more infrastructure to handle it all. So you're right. There is a lot in that data center space happening. In my experience, it's because it's big business. It's also harder for like a smaller, medium investor to get exposure to that, unless you could sell a land position or get in as a REIT investor with some of these companies that are exclusively buying properties for data centers. It's difficult for an average investor to get into it. But you're right. It is a huge burgeoning business, which is not going away anytime soon. Yeah,
I agree. Well, listen, I know we're getting close on time, or usually the half hour is the magic time frame, but we probably just scratched the surface, and I feel like I want to have you back on again to cover more information, because it's such a great subject, and a lot of investors generally think of office, retail, and residential, and not so much industrial. It's a smaller segment, but each piece of property generally is much bigger, and it's usually bigger and returns involved too in a lot of cases. So any final words of wisdom, and then how can we learn more about what you're doing in this sector of industrial real estate? I mean, websites, YouTube channels, things like that. Anything you can give us that would help, that would be great. Yeah, and you're right. Industrial real estate is this
area where people just don't have like a lot of knowledge about. But with that comes a lot of opportunity, because there's not as many people chasing it. It's not as competitive. You'll typically see higher cap rates. You'll have less competition in general of people fighting over the same assets. So there is an opportunity to outperform other asset classes in a relatively stable, at least historically, asset class. So I'm a big believer in industrial myself. I not only work in it full time, I've got the majority of my net worth directly invested in it. So it's a passionate topic of mine, and I'd be happy to come back on another time and talk about some more specific things that investors could look at if they're considering it. I also have a YouTube channel where I talk about industrial real estate. That's all the channel is about. I love talking about industrial real estate, as you can tell. It's what I've done my entire career and where I've got money invested in it. So I try to just provide as much value as I can to anybody that wants to check it out. It's a complete standalone channel for me. I don't talk about what company I work for. I don't even mention what city I'm in, because I don't want it to come across as a sales package for my services. I'm really doing it as just a channel to provide value to anybody that's looking to learn more about it. So if you just search my name, Chad Griffiths, in YouTube, or even just search industrial real estate, I'm one of the few people that talks about it fairly regularly. So I'm sure my channel will show up. Yeah,
that's actually really good, because you're right. A lot of people on YouTube are, of course, it's music and a lot of how-to things like that. But industrial real estate would definitely be a unique channel. So guys, check it out. I just looked it up, guys. So it's on YouTube, Chad Griffiths CRE. Is that correct?
Yes, that's it.
That's the actual channel, Chad Griffiths CRE. But if you just type in, YouTube has the search bar just like anything else. If you just start typing in Chad Griffiths, guys, you'll definitely get it. So Chad, thanks again for doing this. This is a very unique subject, and I was really looking forward to this. And I'm glad we finally did the podcast. And I think a lot of other people are feeling the same way. It gives them a whole new opportunity to invest their hard-earned dollars and something that's it's great long-term investments, guys. I mean, you invest in a Sony plant or a data center, it's not like they're going to leave in the next year. They're going to be there for probably, at least 10 years and potentially longer. I mean, some of there's leases that are 99 years. I mean, it's very stable. It's like having an annuity. So definitely check it out. Check out the YouTube channel. Just go on to YouTube, search for Chad Griffiths, and you'll find it. And while you're online, go ahead and, by the way, go to globalinvestoragent.com and get yourself one of our agents who are trained to work with us investors. They're not regular agents. They're focused on investing and work with us investors. And by the way, please do everybody a favor, Chad, me, and the whole podcast community. Please leave a review. That's the best thing you can do. It's the kindest thing you can do. It doesn't cost anything. It takes about less than a minute. You could even do it in 5 seconds if you're doing the quickie. But this has been a good one, and we really appreciate it if you give Chad a good review on the podcast here. So thank you, everyone. God bless you and your families, and we will see you on the next podcast.
Thanks for listening to this episode of Massive Passive Cash Flow. Be sure to go to realestatewithgarywilson.com to join our community and start building wealth today.